Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool, and one of the founding partners of the Dividend Kings marketplace service here on Seeking Alpha. And many of you who have followed my work for a long time know me or think of me as Mr. Valuation. That's a moniker that I was dubbed by one of my loyal readers that I actually covet very much because valuation has always been a major part of my investing career. And, as such, as I kind of indicated in the written portion of this article, I'm always, as an investor, I'm always looking for a bargain. Because I do believe that by buying stocks when they're at bargain levels, not only do you enhance your rate of return, but you also lower your risk a great deal. So what I'd like to do here is take a look at a stock that I was actually asked to cover, asked to talk about by one of my readers who asked me that I looked at Unum Group. Now, the truth is, the whole financial sector, in my opinion, in today's bifurcated market is very, very inexpensive today. But I also want to point something else out, and I'm going to use Unum here as my example. If you look at the financial stocks, almost across the board, not 100%, but certainly the predominant number of financial stocks are trading at very low valuations. The average PE ratio for common stocks is about 15 times earnings, and I've talked about that quite a bit. That would be the orange line in this graph. That's essentially what a common stock ought to be trading at. The valuation reference line that's blue on this graph, though, is the normal PE, which for Unum has been about 9.39. Now, we'll call it 9 to 10 times earnings. So the reality of it is you can buy a lot of high-quality financial stocks at very low valuations. Just to give you an example, two that I actually own would be Prudential, that I have positions in would be Prudential. It trades at around 11 over this same time frame times earnings, but I want you to notice that it was trading at higher valuations coming into the financial debacle. And then the next one would be Principal Financial Group. So I do want to point out, I actually don't have a position in Unum, but it's an extremely interesting company. And all of these stocks are high quality companies with good ratings. Both Principal Financial Group and Prudential have A- ratings and approximately in the 20% debt to capital. But I do want you to notice the fact that they all trade at discounts. Now, some of these stocks used to trade at what I'll call normal valuations, but today they trade at this, 10-ish, we'll call it, multiple that the market has been only willing to apply to these stocks over time. Now, in the case of Unum, it's been about 9.39 times earnings. Now, I can go into my forecasting calculators, look at the normal multiple, and I have a drop down. I want you to see that this stock has been consistently 8-9 times earnings. It never actually has been a double-digit company. But when I get into talking about forecasting future returns, I'm going to use this normal PE ratio conservatively as my valuation reference, not the orange line. I want to be clear about that. But I want to make a point here. I've seen other articles when I was doing research on this stock. I've read other articles, and people have criticized the fact that if I look at like a 15-year performance result on this company, and I can do that very easily with FastGraphs, you'll see that it has had actually a negative capital loss or capital appreciation. It did pay some nice dividends, which let it eke out less than a 1% annualized rate of return, but that's substantially subpar relative to the average company. But I do want to make a point. That's because the stock is ridiculously undervalued. Today, the stock trades at a blended PE ratio of 3.5 times earnings. If you invert that, that means the earnings yield is 28.33% and the dividend yield is 6.15%. So despite the fact that the market has always valued this at around 8 or 9 times earnings or so, at 3.5 times earnings, it's clearly trading at one of its lowest valuations ever. If I apply the historical dividend yields to this, you can see that even when the stock was really undervalued at the end of 2019, it was only offering a dividend yield of 3.74%. Well, today that yield is up here at 6.15%, so it's even more undervalued than it historically has been. So that's another indicator. But I want to make another point here. I'm going to expand this graph out here. I'm going to take this dividend line off. People, when they're looking at valuation, I say this all the time, measuring performance without simultaneously measuring valuation is a job half done. you're measuring this company at the worst possible time you could. But I do want you to note, when I look at earnings here, the fundamentals are actually very strong. Even more importantly, since it is a dividend-paying stock, if I look at free cash flow and what the company's done here in recent years, now I have no estimates on that. That's why there's a blank space here. But free cash flow has been very, very strong. In fact, as I pointed out in the article, the free cash flow payout ratio is about 14.4%. That's extremely low. There's a lot of room for this company to grow. And another thing, if I look at performance and I drop this down to the period of time since coming out of the Great Recession, I see that even though the performance has been weak, this is a slightly different time frame than I showed you a minute ago, you can see that the dividend growth has been almost 10% a year. If I shorten that just even a little bit more, you can see that the dividend growth rate now runs up into double-digit rates. Since 2008, the company's been increasing their dividend at very substantial rates, as you can see here. Knock a couple of years off of this, and you get up into the 10 or 11%, actually 12.5% dividend growth rate. So the company's been growing their dividend quite nicely here in recent years. And as a dividend growth investor, I think that's very, very important. And the fundamentals, as I've just pointed out, support that dividend growth rate. But let's look at this company from a different perspective. There have been many times when you could buy this stock, even considering its normal low valuation, at extremely low valuations, like coming out of the bottom of the Great Recession, where the PE was 4, which is approximately, or certainly close to what it is now. Now, if you'd have measured that to fair value, which, given the fact that we'll call fair value being this 9 or 10 PE ratio, I'll do it right here, that would have given you an opportunity over the next 5 or 6 years to earn about 19% a year, plus get a nice steady dividend growth every year. If I measured this from the bottom here to the peak valuation, I could have got 22.8%. Valuation matters a lot. Now, when you're buying a stock like this, if you're buying it at an extremely low valuation and the business does well, you've got a real opportunity to make some great money. So let's go ahead and look at forecasting here, as I promised earlier. Let's use the normal multiple, which here I'm going to use a number under 9. This is the 5-year historical normal PE that the stock is traded at, 8.9 times earnings. That's the blue line. If this would move back to just a normal 9 multiple, your annualized rate of return through 2021 would be over 100%, 123%. Out for the next couple of years, it would be 63%. If I look at the long-term growth projections of this company, analysts are expecting it to grow at about 9%. It's historically grown at 6%, and there are some reasons for that, which I won't get into in this video. But again, if I only apply that 9 multiple, you've got a chance to make, in other words, if these earnings manifest and it trades at only 9 times earnings from its currently, blended PE of under 4, you could make 35.4% a year annualized mathematically. That's just simply a mathematical calculation. So there's clearly a lot of opportunity here, but it's primarily a valuation play. And I want to make that clear. But simultaneously, it's also a high yield play. And so let's look at some other aspects of the company from a standpoint of trying to evaluate what the fundamentals of the business are. So the first thing I'd like to do, I want to turn to fund graphs here, and I want to look at some balance sheet items. So let's start with looking at debt, because that's a concern for the company. So some of the articles I've written have worried about the fact that debt has steadily increased, especially since coming out of the Great Recession. You can see that debt has grown. However, if I look at it from the other perspective, not just debt, if I look at it from a standpoint of free cash flow and operating cash flow, I also discover that operating cash flow and free cash flow have actually been very strong for the company as well. In fact, quite strong relative to being able to amortize the debt. The company's got numerous strong cash flows to be able to do that. So fundamentally, the company doesn't look so bad. Now, another area that I would like to look at when I'm looking at a company like this, I want to look at the revenues, and I put an example of that. And you can see their revenues per share have been very strong. The growth, since the Great Recession has been very strong. From 2007 through 2019, they've grown revenues about 5.5%. I lop a couple of years off, and that's up to about 6.3%, which is kind of consistent with what their earnings growth has also been. This is per share data. Let's look at that same information, and let's look at it this time from the standpoint of gross revenues, total revenues. Okay, now here, when I look at that from this, shorter time frame that we looked at earlier, you can see that total revenue has only grown about 1.5 or 2% a year. Again, depends on what time frame I run. It's up to 1.8% since 2010. So the gross revenues have actually increased, but it's nowhere near as fast as total revenues. Revenues in millions or total revenues have not grown as fast as revenues per share. So the answer would be, why would that be true? Well, the answer would be in common shares outstanding. So let's take a look at common shares outstanding, and we see that the company has been buying back stock rather aggressively, averaging about almost 5% a year reduction in share count. They went from 327 million shares in 2010 to 210 million through last year. And from a quarter to quarter basis, they've been continuing to do that. So the company's been buying back shares, but their revenue growth has been strong. Their balance sheet is good. When I look at debt to capital, it's only about 23%, so they're not overly laden with debt. The company has tremendous leverage, if you will, or maybe the better word would be capacity to continue paying a dividend. They pay out a very low percentage of earnings. Their payout ratio for earnings has been about 20%. As I mentioned, for operating cash flow and free cash flow, it's been in the teens. So, what I see here when I look at this company, all in all, I see a high quality company. I talked about their business and their business models. I think the company is actually doing a whole lot better than the market is giving it credit for. So if you're truly looking for a bargain and you're a dividend growth investor, you might be very attracted to a 6% plus dividend yield that's been growing at double-digit rates for the last 8 or 10 years or so. And you got a chance to buy this when it's extremely inexpensive. So you might want to take a closer look at Unum. But again, as I mentioned in the beginning here, I'm currently invested in Prudential, and I'm currently invested in Principal Financial Group. I like the little bit higher quality. This is a BBB rating. That's one grade below investment grade, where Prudential and Principal are A rated, but they offer 5% yields. This offers a 6% yield. They have a little higher valuation, but they're also very attractive as well. Bottom line is it's a bifurcated market. There's a lot of very expensive stocks out there, but there's also a lot of very inexpensive stocks, and I believe Unum is one of them. Anyway, this has been Chuck Carnevale saying, thanks for watching. You guys might want to take a look at the Dividend Kings marketplace service here on Seeking Alpha that I'm one of the founders of, where you can get some really good dividend ideas like this. Thanks for watching.